Thank you so much for joining us today for Hot Picks. We've got Barry Martin. He's lead portfolio manager of the Morningstar 5-Star Shelton Equity Income Fund. Thank you so much for joining us, Barry. And today's Hot Picks, we always try to have a theme. And this one is using covered calls on some of the stocks that you love. If you're, we try and cater to all types of investors, to sophisticated, to the novice investor. So as clearly as you can, first explain a covered call strategy and who it's right for.
Yeah, so a covered call strategy is a hedged equity strategy where a lot of people like to use it to generate income. So what you're doing is you're owning a stock and then you're selling someone the right, but not the obligation to purchase that stock off of you at a predetermined price. And someone will pay you for that right. So for example, Microsoft right now is about $425 a share. You can sell the May 450s, meaning you're selling someone the right to buy Microsoft off of you at $450, which is $25 higher than it is now, and someone will pay you $7 a share for that right. So if Microsoft never gets to $450, you take that $7 and put in your pocket. But if it does get past $450, then you have to sell that stock over to the person that bought the option for you at $450. And now, so that's some people, that's a good trade. So in this case, your stock appreciated $25. You sold the stock. But there's two downsides to the strategy. The one main downside is an opportunity cost. So if Microsoft, for some reason, goes to $500 a share, you're blocked off at $450. Yeah. But if Microsoft drops $25 a share, your Microsoft will also drop $25, but you're offset by the $7 you receive for selling that call.
So it sounds like it's the right strategy, obviously for somebody who's looking for income, but maybe a more patient investor who's not expecting any kind of blowout, in either the numbers or the stock. It's just kind of a nice sideways trader.
Exactly. So with covered call writing, you have asymmetric returns. And what I mean by that is that your upside's capped at a level, but you do have some downside risks that you have to be aware of. So we believe the best type of stock to own is basically perfect for the type of investor that you just recommended, is a defensive quality name. Really quality names, large cap equities that have a diversified portfolio, or equities that have a loyal customer base, equities that really protect that downside risk of owning that stock. Because with covered call writing, you can't hit a home run. Like you can't round the bases here. You can only hit base hits, singles here and there, and chip away at it. So you're right. It's not the client or the person that's really bullish on a stock. It's or the market, right? Even at a market we're at today, it's a little frothy. So this might be an appropriate strategy who someone thinks that, kind of the end of the market appreciation. So we'll sell off some upside and take advantage of that and generate that income that people are looking for. And
before we talk about the stocks that qualify, what kind of yield are we talking about?
Yeah, so in our mutual fund, our goal is to generate anywhere between 6 to 9% in a combination between option premium and dividend yield. So right now, Morningstar has us slightly below 8% trailing yield, and that's that combination of a couple things, but mainly the option premium and the dividend yield that's being paid on the underlying equity. So you can see it's pretty attractive. But when you're selling covered calls, you could be more aggressive. The thing is, what we try and do is we have a balancing act between appreciation of the stock and the stock being and the option premium that's being received. So you can write at the money and then take more off the table, or you can write further out of the money and take less. So it's really that balancing act that we're trying to figure out, where customers and clients and retail folk need to be aware of as well.
All right. So stocks that you write cover calls on: Amazon, Microsoft, as well as Costco. How did you come up with this list? What do they have in common?
Yeah, so they're in our top 10 holdings, and basically it goes to the point of a defensive quality name. So we look at various factors, and we look at a lot of, superior covered option writing. They've done some factor analysis on great performance from covered option writing, and two factors came out. Basically, stocks that generate free cash flow and large cap equities. Those are two factors where it equates to really good performance for covered option writing, and those fit that factor. Now, saying that, these stocks also have enough volatility where we're able to sell calls on these underlying equities. So as volatility increases, we can receive more from selling calls. So for us, it's a nice balance between a defensive quality name that mom and dad know, that are in a good business, that are market leaders, that have a loyal customer base, and also on the flip side have enough volatility where we're able to generate that income and sell those covered calls to make our intended goal between 6 and 9% in option premium.